All right, welcome. It's Brandon B. Dixon. Y'all tuned into another webinar. Today's topic, we're talking about investment lending. We're talking about DSCR financing. And for those that don't know, DSCR means debt service coverage ratio. So we're going to talk about this and we're going to break it down in depth. First thing first, before we get to it, let me go ahead and introduce myself and then my co-host, Anthony Gallup. He's going to introduce himself and we're going to get right to it. So first thing first, if you don't know me, my name is Brandon B. Dixon. My NMLS is 1541210. It's at Billionaire Loan Officer on all social media. Also, you could get in touch with me at www.applywithb.com. You can book me for a consultation there, or you can apply for a mortgage. You can call me 832-753-5541. Call me 24/7. Text me, whatever you got to do. And you can go to brandonbdixon.com if you want to lease, if you want to list. I'm available as a licensed realtor as well. So from there, Anthony, you go ahead and take it away.
Yeah. Thank you, Brandon. Guys, my name is Anthony Gallup, NMLS number 1066511. I'm also called the mortgage prepper, not like a survivalist, more like a strategist, someone that sees the playing field before we even step foot onto it. I help people empower themselves by securing their own legacies through prepared home ownership. You can find me at themortgageprepper.com, and that way you can also follow me on my socials at the Mortgage Prepper, or you can reach out to me directly at 919-336-0099. You can text or call anytime. And we're super excited to bring you this webinar, and let's get started.
Gotcha. All right. And you want to go ahead and add everything to the stage, the webinar?
Yep, let's get that going. Oh, all right. We are in business. You guys can see that?
Yep, we can see it. All right, you're going to lead it off right on the...
All right, guys. So we're going to talk about investment lending today, and it's particularly DSCR, which is the debt service coverage ratio. And we're going to do a deep dive as to what this loan is, how you can qualify for it, and the best practices you want to have going forward to make sure you have an easy transaction. All right, so let's jump into it here. And the first thing we're going to cover today is we're going to cover what that loan is. What is DSCR in plain English? We'll make sure you understand that completely. And then we'll understand why the rules you read online aren't exactly the real rules you see regarding this loan program. And obviously, how little you might actually need to put down, right? That's a big thing. A lot of times you see misinformation online, but we'll dive deep into that. And then we'll look at options for first-time investors, for folks that are self-employed, and everyone in between. And then we're going to talk about ways to pull cash out and keep growing as you grow your investment portfolio. And then we're going to talk about how to get started, right? The real simple process on what's the first thing you want to do to jump into this.
Gotcha. All right. So what is a DSCR loan? DSCR loan, like I said, simplified is debt service coverage ratio. It's where we use the rental potential versus the payment. And we ask the question, does the property pay for itself? If the answer is yes, then that is sufficient enough to income for this particular product. So if the rent covers the mortgage, you're in the game. That's all you need for the whole loan. We don't need W-2s. We don't need bank statements. As far as for the proof of income, the rental income is the proof of income. So no tax returns, no debt to income test, and it is a real mortgage. You have 30-year, even 40-year. I've done a 40-year before. So you have all kind of options as far as DSCR. So this helps investors or people that are self-employed, that most investors like to do max deductions, like myself. I'm going to file off everything. I don't like paying Uncle Sam. So on paper, it looks like I don't make a lot of money. What happens is it hurts the debt to income ratio. However, you have enough payment to put down, and if this is going to be a rental property, then we could use the cash flow of that rent as the potential of that rental income as your income. So
yeah, so there's more than one way to qualify for these DSCR loans. Obviously, there's the no ratio option where the rent is slightly below. So we always like to say, as long as the home cash flows, that means the rent is going to be more than what your actual mortgage payment is. But there are options for people that are investors that are playing a different game. Cash flow is normally always king, but there are often times where getting a property in this particular neighborhood at a particular time might be the strategy where you might take a loss on cash flow. So no ratio is for those type of investments where the rent happens to be below the payment, right? Even when the numbers don't fully cover it, there's still a path forward for that type of financing. And obviously, you want to be in that building stage where the rent nearly covers it, almost breaking even, still opens up strong options for you. And then obviously the standard one where the rent covers the payment. That's the ideal situation. Premium, where you get the best financing terms, is when there's strong positive cash flow right out the gate, right? A surplus each month earns the best pricing when it comes to rates and other requirements.
Gotcha. So typically it's 15% down on an investment property. Less than you've been I don't know see what the last part is, but most people have assumed or read online is 25% down. We could get you into a DSCR with as little as 15% down on a purchase. No income docs needed from there. Gift funds may be allowed towards that down payment. First time investors are welcome as well. The exact number definitely depends on your credit score. So the better your score, the less you have to put down. So that's the quick conversation of it.
Yeah, and there's the internet's rules, and then there's reality, right? So what you'll read online typically is you need a 680 credit score, but in reality, there are options that exist well down into the low 600s, right? You also see the rent has to cover the payment, right? That's something we saw on the last side. But as you guys can tell, there are programs for people that have the rent that doesn't quite qualify or doesn't quite cover the actual payment that you end up with. And then most people, like you said earlier, Brandon, they're thinking 20 to 25% down. There are 15% down options, and these options are few and far between. Let's not get that twisted. But for the right property and the right investor, you could get as low as 15% down. And then oftentimes people think you have to wait 6 to 12 months just to access cash on your investment. There are immediate cash out possibilities for certain options. Okay, so don't let that deter you. You can access your capital much sooner than the internet will tell you. You also don't have to close it in your own name, right? Obviously, as investors, we have these entities to protect us and protect our investment. This applies in this realm as well. So you definitely don't have to close in your name. You can close in a company or an entity you're choosing. And then obviously Brandon mentioned earlier, 30-year options are the norm, but there are 40-year options whereas 10 years might be interest only, and then it reverts to a 30-year amortization schedule. So there are a lot of different nuances to these programs that you don't see online. So again, what you'll see on this as a recurring theme throughout this presentation is that you got to talk to someone that's an expert on it, right? You want to talk with a broker, someone that has many options, because some of these fringe options as far as lower credit scores, 15% down, 40-year options, these are being offered by different investors. So you're not going to see them consistently across every single lender. So that's why a broker is important, because we can access and tap into these investors.
Gotcha. All right. So who DSCR loans are built for? A is growing investors. No income cap. So there's no hard limit on how many properties you may qualify for, or how many are in your portfolio. Isn't capped as well. For first time investors, if you want to get into the game and you want to get into actually the real estate investing, and your debt to income ratio might not handle it because you're working a salary or something to that effect. This is great for those. Foreign nationals, I've done one of those before. So if you're a foreign national and you're here on a visa, there's investors that take care of that as well. That'll allow you to invest in property in the U.S. Self-employed business owners, realtors, caterers, Uber drivers, whatever. So if you're self-employed, and most business owners and self-employed people want to not pay the government. So as you know, with traditional loans, you're going to need tax returns. And for most people, they want to take advantage of deductions. I mean, for you to take advantage of. So most people do. However, the catch to that is that it's not the gross, it's the net when you're self-employed or a business owner. So that comes back to bite you when you're trying to borrow money. Not in this case. So it helps you in this particular case. So first-time buyers, if you're currently renting, but hey, I'm currently renting. I like to move around. However, I still want to invest. This doesn't exclude you. So you're able to be in a rental currently, and you want to invest. They have investors that'll help you out as well. Also, I-10 borrowers. That's another thing. If you have an I-10 number, you're able to get this product as well.
Yeah. So what if the rent doesn't cover the payment, and there's still a loan for that? Remember, because we have options that don't quite that help investors that may not quite get there up front, right? So some of these programs don't require the property to break even at all. And instead of leaning on the rent, they lean on your credit, they lean on your down payment and your reserves, right? The more money you have in your bank usually strengthens the file for scenarios where the rent doesn't quite match the payment. Okay. Now, there are some different caveats to that. Newer and seasonal rentals, these properties are still ramping up, or with seasonal income that don't have to be perfect on paper. Okay. And then you also have value add deals. Buying a below market to improve later, you don't get penalized for today's rent. And another option is stronger buyer type deal, right? So you have an excellent credit score and solid, strong down payment, can carry a property that's slightly short when it comes to cash flow, right? So it's not so much of the individual circumstances of each loan, it's more of the total picture, right? I have a saying in this business: cash rules everything. The more money you have, the better, right? So it's the same thing. The better credit you have, the less cash you may need. The more cash you have, the lower credit score you may need, right? So it's kind of the theme here. If you've got one strong aspect of the table, you may not need all four legs to be equally strong, is what I'm saying.
Gotcha. All right. So Airbnb and short-term rental income counts as well. So yes, vacation rental can qualify you. So short-term rentals earn more typically, and that's an upside that can count. So if you're in an area, like I was just telling Anthony off camera here, I was just in an area that's a sought after, like a secondary home or a vacation area. So that can lead to more rental income to help you qualify and get better rates and get better terms. Market data can stand in for a lease. So a lot of times we use not just the appraisal, the appraisal that or comparable rent schedule. A lot of times, depending on the lender, we use what's called a table appraisal, where they look at the market data as well. A track record helps as well. So if you're buying this from existing investor and they already have a track record of actually a rental history, or they already have a lease in place where you can prove that could help as well. That could be used instead of the 1007, which is the comparable rent schedule. It's great for beach, mountain, city markets as well. So I give you an example. In Houston, we have all of the above. We have inside the medical center where a lot of travel nurses come in, and they Airbnb. This is great. You could go to where I was at today, and some of the either north or south, where you have some of these lakes and you got some of these beachside properties. We don't have mountains, but we do have strip malls here in Houston. But but you got a variety of different things that you could qualify for, and as far as the way we could do DSCRs, short-term savings um, swing more than a 12 months leap most of the time because you're charging more because it's short term. So that's the good news about it.
Yeah. So another myth you see is that first timers can't do this, right? That's absolutely not true. Because whether it's your first rental or your first property ever, there is a pathway built for you, right? Now, if you've never owned a rental, you don't have prior landlord experience, right? But your first deal can still be a DSCR deal. Even if you're still renting yourself. I closed a client last year that this guy was in college and he had no primary residence. He was living in the dorm, but because he had access to excellent credit and he had good, strong down payment, he bought his first property, which turned out to be a duplex rental. So this guy, he was actually understanding the leverage that real estate can apply to your life and your financial setup, and he was jumping out right out the gate without even paying for a primary residence, right? And then even if you're worried about your credit, right, the bar is a lot lower than people think, and we'll figure out what your options are before anything is really pulled. We can look at soft pulls and kind of get a gauge for what your score is going to look like, and if we need be, we can strategize to tweak your scores so that it shows in the strongest light when we do need to do the hard pull, whether that's manipulating the balances on your credit cards and figuring out when they report and what time do we need to pull the credit to get the best score possible. So that strategy is all part of the plan. And then if you're not sure you even have enough, between these low down payment options, gift funds, right? So if you've got a family member that's wanting to provide you gift funds to help you with your first investment, that's also an option. The entry point is a lot smaller than most people expect, right? So this isn't for a super aggressive investor that has 300-400 properties. This can be for that very first home buyer or first time investor that's looking to get into the business, and we can strategize a plan for you that spans your first property all the way through your last. Oh, and before we let go, the rent to owner path, right? Buy an investment property using the rent to qualify, right? Let the tenants help pay it down. You build the equity and you build that confidence, and then buy the home you live in later, right? That's the strategy that my past client is doing. He's letting his tenant pay down his mortgage, give him access to capital, and then he's using that to buy his house later, where his tenants will eventually end up paying for that.
All right, so no U.S. credit, no Social Security number, no problem. Still possible. So foreign national, you could earn your income abroad. If the property qualifies and is not your home company tax system, there's a path. A passport and a valid visa can be enough to get started. International bank references or U.S. assets can stand in for domestic credit history. You typically close in a U.S. LLC. Simple to get set up, and we'll walk you through everything. I-10 borrowers, if you have no Social Security number, I-10 works with select programs. You could build real estate wealth on the books in your name the right way. First-time buyers with an I-10, y'all could qualify too. If you're not on the outside of the market, there's a seat at the table for you as well. So I-10 borrowers, foreign nationals. I've never done I-10, but I have done foreign nationals as well. So got a lot of people that I know in Nigeria. So they always come and buy here, especially here in Houston. So yep, it happens all the time.
Yeah, and here's the thing: if once you're ready to scale beyond a single home, we have options for these small multifamily properties, which are 5+ units, right? These apartment buildings and larger rentals are underwritten on the building's income, right? Which is a natural next step once you outgrow a single family. So as you're growing in your investment journey, understand that you have options to kind of help you take that next step as you increase or change the properties that you're investing in, right? Mixed use and commercial is another popular one, where you have a retail, office, a warehouse, storage, or whatever mixed use property. We have investor friendly options that can qualify on the property's cash flow, right? That's a theme here with investors is it's not so much your income, because if you're a true investor, right, you have your hands in different pots, you have a lot going on, and if we're trying to qualify you the traditional way, let's get your bank statements, pay stubs, and your tax returns, it can be a nightmare, right? So this is why this helps for investors, because we don't have time to be, dragging out all these documents, all this documentation, just for you to say, hey, we don't show enough, you don't show enough income on paper, right? It's all about cash flow. The property is the deal, not the buyer, not the investor. The property is the deal, right? So, own the building your business uses, right? So if you have a business, there are a lot of commercial financing. There's a lot of SBA financing options that could help you run a business and have a low down payment path to own the property that you're running your business out of, instead of just renting it, right? So that's another aspect of this, that once you get your feet wet, you can kind of upgrade into these different financing strategies.
All right. So, want a lower payment? There's levers that you could unlock. The lower payment means better cash flow and more properties that you could pencil out. Um, this is a simple illustration. Like a standard 30-year, that's the highest payment. You could do a 40-year term, lower payment, or you could do interest only. I've done one of those as well. So those are good for if you want to cash flow immediately. If you have a strategy to refinance later, that's a possibility. There's two cash flow boosters. There's interest only payments, where you could set a period, like most of the time it's 10 years, where you can pay the only interest. The payment drops and your monthly cash flow jumps. Ideal if the markets where you're according to, if you're banking on appreciation. 40-year term, spreading the loan over 40 years instead of 30 shrinks the payment without interest only period. There's more breathing room every month. So this depends on the property. If a property fits, there's flexible financing available to fit your cash flow expectations.
So, there are also ways that you want to be able to tap into your equity once you have this property financed, right? Or once you have the property stabilized. So you can turn a built up equity into cash for your next down payment. So you can leverage one property's cash flow or the equity there and help you make the move on the next property, right? There are no income documents. Property still does the qualifying. And with certain options, you don't have to wait months to do that, right? Traditionally, you were under the assumption that you had to wait at least 6 to 12 months sometimes to tap into equity that you own a property that you bought recently. But there are options that you can tap into that immediately, okay? And then there's the engine behind the classic buy, improve, refinance, and repeat strategy, right? That burn method. This is exactly how they're doing it. They're cashing out property very quickly from once you have it stabilized and fully mapped out and able to be rented out. So the nice thing about it is that there is a way for you to keep your lower rate, right? You don't have to give it up to access your equity. In the past, you would have had to refinance the entire property, and then whatever rate you had, you would have to give up to get whatever a cash out investment property rate would be, which we all know they're not the greatest. They're often a little bit higher. But there are options where you can actually not have to touch that first mortgage lien or that rate if you have a good rate. For example, if you bought a property as a primary residence, lived in it, and now you're moving out and you're going to be renting it out, you don't have to give up that lower primary interest rate that you had previously. You could theoretically pull an equity line out on that property and just take out a new interest rate on whatever equity you tap into and keep that first mortgage rate in place, right? So this is how you kind of game the system in a way that you don't have to get penalized for moving out of a property if you don't have to.
All right. So why this loan just moves faster? All right. So there's no waiting periods. So most of the loans have a mandatory delays. Customer mortgages require. Some deals close in a couple of weeks. So this is a lightning fast loan. There's zero income paperwork, so you don't have to scrounge around and look for income paperwork. W-2s you have to pull up. stuff like that. More flexibility on structure. So, like we talked about in the previous slide, there we could go 30-year, we could go 40-year, we could go interest only. You could close in your LLC. So if you already have an LLC set up, that it's possible to do that as well. Often off your personal credit. So you could, if your business has established credit as well, you could close underneath that business entity as well, and then use that business credit, and then that way you don't have your utilization or your liabilities on your personal report. And then we move at the speed of the deal, so there is less red tape. There's since it's non-QM, meaning that it's non-qualified mortgage, which means that it's not backed by Fannie or Freddie, it's private investors. That means there's less red tape through government bureaucracy. So that means that it's generally investors, so it's lightning fast. So there's no red tape involved.
Yeah, so there's different types of these strategies. All right, as an investor, you're looking at flips, bridges, and there's also business credit available, right? So for short-term and fix and flips, there's financing that's built to buy, renovate, and sell projects on a shorter timeline. And then these loans are on what the property will be worth once it's fixed up, right? So not quite what we're looking at now when you buy it, but what it'll end up being once it's stabilized and ready to hit the market, okay? There's an interest-only section, time frame during the project that keeps your carrying costs down. So while you're building the property up, you're not getting hit with a high payment each month until you get that property ready to go. And then the closings are quick, right? You can really compete with cash buyers out there because we can get this wrapped up about as quickly as it takes for you to get the property appraised. So as soon as they can get an appraiser out there to see what the property looks like and what it will be, closing is, a couple of days after that, right? So the other option is business credit, because this is a really good advantage. Beyond the mortgage itself, you can build funding in your business's name to fuel down payment and reserves, right? You have access to sizable unsecured funding, often without collateral, right? It all depends on the particular situation, but there are options that don't require you collateralizing or putting up a property for collateral. It doesn't always require a long business history or revenue. You can pair it with a DSCR loan to cover the cash you need to bring in, right? And this keeps your personal finances and your investing money separate. Okay, so there are different types of financing strategies depending on your ultimate goal and what strategy you use when it comes to investing in property.
Gotcha. What actually moves the rate? All right. So first of all, the most important thing is the credit score. So that determines a lot as far as what your rate's going to be. Rent versus the payment. So as we talked about before, if the rent covers the actual payment and it actually cash flows, that's going to be the best rate. If it's equal to or a little bit less than, that's going to slightly lower your rate, and sometimes it can increase the down payment as well. If it's no ratio, that's going to be the most down payment, and of course you're going to need the best scores for that. So a lot of times it's not going to be the best rate, but a lot of times they're not that far apart. They're within earshot of one another. Loan size, of course, if you're jumping into over $1 million, sometimes depends on the investors, over 2 million, then that can affect your rate as well. Down payment. So the more you put down, a lot of times you jump from 15 to 20 to 25, sometimes even 30. That is going to decrease your rate a lot of times. So again, the more you put down, the less risky. So the favorable the rate will be. Prepayment choice. So sometimes there's no prepayment penalty, which is going to be the most interest rate, up to 5 years. 5 years is going to be the least. So you could, and what prepayment penalty is if you pay it out or refinance or anything before, you have to pay a penalty. Usually it's about anywhere from 3 to 5%. Then it depends on the property type. Single family, of course, is going to be always the best. But if there's an ADU or something else unique or different about it, of course, those are probably going to be higher rates. But all of this is doable.
Yeah, so the quickest way to get started, guys, is you hop on a quick call, right? Brandon and I are available either through our websites or through our direct phone numbers, where you can kind of hop on and get on the schedule to have a strategy call session, right? Because that's the most important thing. You have to figure out what you're looking to do, what your goal is, what your future plans are down the line. That's important when it comes to investing. And what we'll do is we'll eventually do a gentle credit check, which is oftentimes ends up being a soft pull depending on the scenario. And then what we want to do is we want to strategize based on what that pull shows us as to when we want to do the hard pull, because a score showing at 690 versus 730 can be the difference of a couple of $100, $200 a month in cash flow. So we want to make sure that we are positioning you as the investor in the best possible position to maximize and get the best rate and terms available. Okay. And then we'll obviously run the numbers, right? As investors, it's all about making sure the numbers make sense based on your buy box and what you're looking to actually do. And then we'll match a program that fits what your goals are, and we'll go ahead and make sure that you're positioned to make sure that the appraisal and everything is going to come back the way we want it to come back. Because obviously, whatever the house is renting for now, oftentimes in a lot of these deals, the appraiser is going to be the end all be all as far as what is the market rent expected to be, right? Unless you already have a lease in place. But if it's a property that isn't quite stabilized, not leased out yet, then oftentimes the appraiser is going to be determining what that average rent is, and that's the number we use to determine your program terms. Okay, and obviously once we get to close, usually it takes these little deals are closed in 2 to 3 weeks oftentimes, right? So that's the most important thing. This is how you get started. It's a pretty easy process. The first step is get in contact with one of us, and we'll help you prepare for that strategy.
All right. So your first deal could be closer than you think. Go ahead, schedule a call with me, 832-753-5541, or you can contact Anthony 919-336-0099. So call for your strategy call. If you're in any area in the U.S. where with DSCRs, we could do, since it's commercial, we could do all 50 states, I believe, on Puerto Rico and the U.S. Virgin Islands, since this is an investment property. So anywhere in the U.S., if you're seeing this, contact us if you want to get into the investment game.
Absolutely, guys. Again, this is my name is Anthony with themortgageprepper.com. Feel free to reach out to us, give us a call, shoot a text, hop on the website, schedule a time, and we'd be happy to help you map out your investor strategy.
Gotcha. Or don't forget, you can go to www.applywithb.com. You could book me for a consultation there, or you could apply right then and there.
Sounds good, guys. All right, thank you for spending some time with us, and hopefully you learned a little bit of something. And we'll be back later on with some more information and some more gems, guys. Have a good one.